It's Jonathan Wellham and Andrew Chang along with Jesse Vandermeer, and we're looking forward to our fourth webcast. And for each of you who have joined us, and for those who will watch on the replay, there's a copy of the presentation below right on this link. So I'd encourage you to snap on that, because we will be making comments and referring to that presentation fairly extensively throughout the presentation. So what we've entitled this presentation to be is investing in a world with negative interest rates. So we want to just talk about the whole issue of negative interest rates and how we're approaching that, how that's impacting us in terms of our investing. And then we are going to, of course, cover off a couple of companies. Andrew and Jesse will be talking about two of our holdings. So if you're going through the slide presentation, you'll see that the next slide actually is the disclaimer. That's important for all the legal reasons. We're in a highly regulated industry, and so we encourage you to look at that disclaimer and to digest the contents of that. In terms of this presentation, we're going to very briefly just talk about the ROCKLINC investment philosophy, just cover that very quickly. Again, it's always important to go over that. Talk a little bit about the investment challenges that we're facing. And the one we're going to zero in on will be negative interest rates. We want to talk a little bit about that. And then also what we're doing in your portfolio, some of the fine tuning that we're doing so that we are best positioned for the current environment. And then I'm going to hand it over to Jesse, who will talk about one of our companies, American Tower, and then over to Andrew, who's going to talk about Thermo Fisher. And these are two holdings that we have throughout our various client portfolios. So let's just jump into it really quickly. On the next slide that we have in our presentation, and I'll go to the slide deck in just a few moments, we really just talk a little bit about ROCKLINC, our history, the size of the company, the uniqueness of our firm, which is really building high quality, customized portfolio based upon our client needs, and also based upon the realities of the world that we're in, not just consensus investing. And that's important if we're going to continue to differentiate in our portfolios and outperform. And I do have a couple slides later talking about the performance of our overall group of assets, which would cut across all of our clients. And you can see when we get there that we've been very fortunate over the last couple of years doing very well. In terms of our investment philosophy, which is always important to hammer the investment philosophy, we're value investors. And so we're trying to buy excellent businesses. What we mean by that are businesses with great long-term financial fundamentals, returns on investment, lots of cash flow, defensive kind of businesses. We also focus our portfolio. So we're very different than the vast majority of the market out there. We like to only buy 20 to 30 securities. And so we're not all over the map, and we want to differentiate. We want to buy intelligently each and every business that we own in the portfolio. We also are longer term in our perspective. So we're looking at longer term trends, 3, 5 years, and even longer. And this means that we're not focused on just short-term speculating. We want to compound over the long term. This is also very tax efficient for our taxable clients when you're in taxable accounts. And then we want to buy the margin of safety, and we want to be very cognizant of the economic environment that we are in. And we're going to talk about that today for a few moments. As we've highlighted for the last 10 years now, because ROCKLINC's been up and going for 10 years, we're very concerned about the debt levels. This is a major issue. And one of the reasons why we have negative interest rates is because the debt is so high that we can't even really run an economy on normal interest rates anymore. So we're concerned about the debt. We're concerned about these massive government promises. The governments continue to promise more and more. We're in an election cycle, so you know that that's the case. People love to hear about freebies, things that the government says they'll give you for free. They should realize, of course, nothing is for free, but we've got all these pensions and promises going out into the long term that we can't afford. This is a major issue. Aging population is another major challenge. And then the issue we're going to zero in on today will ultimately be the monetary policy. Over the last decade, even longer, we've been running, the central banks, that is, have been running a monetary policy where they've been printing a lot of money, adding a lot of currency to the system, and driving interest rates down. And this, as we've talked about before, is largely because of the debt crisis that we are involved in, or we're enveloped by this massive amount of debt globally that is somewhere around $260 trillion and 3 to 4 times what the global GDP is easily. And so this is sort of the environment, and this will, logically lead into how we're approaching investing and why we own the businesses we do. Now, right now, I'm going to just move over to our presentation. So I'm going to share that screen. And I want to just highlight a couple of things before we get into the negative interest rates. So just bear with me for a moment, and I'm going to do a share screen, and we'll come up to our presentation in just a second here. There we go. So we talked about this. I'm just going to fast forward through the slides, which I've already covered. And then, again, the investment challenges. And then key implications. Let me just mention quickly a couple of key implications. What flows out of the challenges that we're facing? So I've just listed a couple of items here, 5 items. First of all, it's going to be very difficult to end money printing and reduce the balance sheet of the major central banks without a recession. And we're seeing that right now. It's very difficult for the global central banks really to get out of the bind that they find themselves in, and that is money printing and keeping interest rates quite low. The second issue there, again, it's impossible to materially raise interest rates without a global recession. And the Federal Reserve yesterday just dropped rates again. All around the world, we see interest rates at record low levels. And that's because the debt is so large. You can't ultimately afford to service the debt at high interest rates. This means that we favor hard tangible assets in our portfolios. And throughout all of the investing that we're doing, we're looking for businesses that are backed by real assets. They're scarce. They have proven business models. They can weather a challenging environment. We also, and I'll talk a little bit about this in terms of the fine tuning in a few moments, increasing exposure to monetary substitutes. So we've been twigging up our exposure to gold and to silver and some of the precious metals, because those would be hedges if things get a little bit messy in the global markets. And then, of course, we always want to maintain some firepower. And that means some cash and short-term investments. So if things get rocky, they don't go down, but it also allows us to be able to buy more of what we really like. Now, on the next slide here, we're going to shift over just quickly to look at this whole phenomena of negative interest rates. This is something that's really new to the global financial system over the last, really just over the last sort of probably 5-6 years that we've seen this come up. And so this chart here tells you that most of the negative interest rates really are in Japan and then in Europe. They haven't hit Canada, the United States, Australia, and some of the other markets, the emerging markets, of course, because of risk. But if you look at this chart, you can actually see here the difference between 2018, November 8th, and then August the 5th. And these go back to relatively close proximity to the time that, to today. You can see that even countries like Portugal and Spain and Ireland, you take those 3 first countries there, they were just even a few years ago, they were called part of the pig countries, Portugal, Italy, Greece, Spain, Ireland. And that's because they had tremendous credit problems and people didn't want to invest in them. Now, Portugal, actually on the short end of its yield curve, on the short end of the bond, short-term bonds, they're actually experiencing negative rates. In other words, if you bought a Portuguese bond that was a very short-term bond, you'd get less money back than you put into it, which is really mind-blowing. Now, if you go down further, you can see countries like the Netherlands, Germany, and Switzerland, which would be 3 of the last 4. They have negative interest rates practically right across their whole yield curve. So going out 15 and 20 years, there's negative interest rates, which is really, really phenomenal when you think about it. It's quite shocking. And it should tell us, I've gone to the next slide here, which just emphasizes again how long out the bonds go where you have negative interest rates. So for example, you take Denmark, which is at the top. If you go out to 15 years, you buy a 15-year Danish bond, you're actually going to be compounding at negative, say 0.5%. This is saying 0.498. So you're losing 0.5% a year compounding if you buy a Danish 15-year bond. which is, again, shocking. And what we're trying to emphasize to investors, our investors, is this concerns us. This tells us that the global financial system is sick. It's not healthy. When you have interest rates that are not even a positive nominal interest rate, forget about even protecting from inflation, but even your top line number is negative, because if you think about it, you're getting 0.5% negative return on that Danish investment. But inflation around the world, in most industrialized worlds, say it's running 2-3%. That means you're losing 2.5% of purchasing power every year. I mean, that's shocking. And that's a horrible investment, and it's telling you that the global financial system is under a lot of stress. This chart here I find quite interesting. Let me just give you a quick interpretation of it. What it's saying is, if you take the major countries around the world and you take the fixed income yield, the amount that's earned off of bonds, and you take sort of these major governments, major countries, the US, the Switzerland, all through the European situation, the Japanese bonds. At one point in the middle of August, this past August, 94% of the world interest was being paid by the US bonds. That's because so much of the world's negative. So when you actually add them all together, the US is contributing 94% to the yield on bonds globally. Again, this is a shocking statistic, and it should concern investors, because it's not balanced, it's not healthy, it is not sustainable, and this is a problem. So what does that mean in terms of negative rates? What are the effects of this? And I've listed just 12 items that I'm going to go through very quickly. And number one, it distorts the price of credit risk. In other words, if you're going to value bonds and credit, you're going to value them based upon the interest rates. Now, if you take interest rates all the way down and actually take them into negative yields, then there's no return to be made. And it's going to distort the price of risk. It's going to mean that credit risk, it looks like it's not even risky anymore, because there's no interest rate attached to it. And so it really messes up all your pricing of fixed income securities. And it doesn't stop there, as we'll see in a few moments. It actually goes into all the asset classes. So if you're a pension fund or an insurance company and you're trying to grab some yield because they have to make some return on their investments, what is forcing a lot of these pension funds and insurance companies to do is go out further and buy longer and longer term bonds, which are actually riskier. So with interest rates coming down, one of the impacts of that will be for long-term investors like pension funds and insurance companies. They're not going to look at 5-year bonds anymore. They have to go out 10, 15, 20, 25, 30 years. But then they take more risk. So that means there's more risk put into our pension funds, more risk into our insurance companies. The second item, just quickly, is the same thing will happen across equities and real estate. As interest rates come down, the value of real estate goes up, the value of equities goes up. But that means you're actually increasing the risk of those investments, because you're paying more for real estate, you're paying more for equities. And the risk premium on these assets will force up the price. And we've seen that in real estate, we've seen that in equities. What does that mean for us as investors? We got to be careful about valuations, because we don't want to overpay. Because if we start overpaying for equities on your account, and then all of a sudden interest rates start to back up a bit, the value of stocks can really drop a lot. So we have to be very careful. The third one is lower bank profitability. The banks, of course, make money on spreads and being able to borrow short and then pay, put that money out long term. So your deposits come in, they pay you a small amount, and then they lend that out in mortgages, and they make a spread on it. But as interest rates come down, it's very hard for the banks to make as much money. So what does that mean? The banking system is made more vulnerable. And we see that in Europe. We see that in Japan. You wouldn't want to own European banks. You wouldn't want to own Japanese banks. But we're also seeing that puts pressure on our North American banks. So we stay, again, way underweight in terms of our banks. And we're very cognizant of the fact that many of the financial institutions are not great places to be investing. On the next slide there, fourth, in Europe, what we're seeing as the rates have gone negative is that people are actually not borrowing. So the economists and all these brilliant, central bankers figure if you just keep lowering interest rates, people will take on more credit. What's actually happening is the opposite. As interest rates have gone negative, credit creation is dropping. It's been reduced because people are getting concerned and more conservative. So it's not working. That's the whole point. The fifth item is that as interest rates have gone negative, the savings rates of households and non-financial corporations in these regions has actually gone up. So again, people are not going out and being careless. They're not pounding on more debt. They're getting nervous, concerned, and they're causing them to save more, which actually makes more sense, because if you're not going to make any money, any interest on your money, then you're going to have to set aside more money, aren't you? And so the fact that this is not working well for the central banks. They thought lower interest rates to stimulate the economy. Not working. Hasn't worked in Japan. It's not working in Europe. And it won't work here too if our central banks are as foolish as what we've seen around the world. Six, it crushes returns on money market funds. Again, just having your money sit in short-term investments, it's a tax. You're actually losing money. And this, of course, is a terrible thing for the financial system. It's reduced liquidity in the fixed income markets. What that means is as bonds become tougher to buy and sell, and so you can get stuck in positions. We worry about that when it comes to ETFs, which we don't own in our group. But if you own ETFs or these exchange-traded funds or bond funds, they could become quite illiquid, and you could get trapped in some of these investments. And so we avoid them. And we just buy individual bonds, and so our investors are not forced out of any investments at all. They own them directly. And then just the last couple of items here, liabilities for pension funds and insurance companies go up. So the reason for that is if they can't make any money on their investments, then ultimately their liabilities start to increase. If a pension fund or insurance company can make 10% a year, then they don't have to set aside as much money. If they can only make 2% or they're making nothing, then their liabilities and how much they have to set aside to pay their obligations goes up. So there's a lot of pressure on pension funds, insurance companies. Wealth inequality, ninth, increases for households and businesses without capital assets. What we're saying here is if you want to talk about wealth inequality, what happens when you start to mess around with the pricing of the risk premia in the market and you drive up the value of real estate investments. If you're someone who doesn't own real estate, you don't own capital investments or stocks, you get left behind. And so this has put a lot of stress on the next generation as they try to step into a market that's been overpricing assets. 10th, the central banks are increasingly trapped. We see this, and we're very cynical and really question the viability of the strategies of the central banks. And so we want to be careful. And you also, 11th, create zombie corporations. In other words, if corporations don't have to really pay the proper price for capital, they're getting it for free or very low rates, then they can survive longer. And that's not a good thing in the capitalist system. What you want is discipline. You want ultimately people to pay a proper price for their money. And if they can't survive and they can't compete, they can't make the profit margins, they need to go away. And we call that creative destruction in our system. And then lastly, what we're seeing also is that these low interest rates in Europe and in Japan putting more pressure on currency wars. And we see that especially in the United States, where they're trying to balance their trading deficits. What they're saying, what President Trump is doing is he's saying, listen, how can we compete with Europe in terms of their currency? If they continue to drop interest rates and they go negative, that means their currency drops, and then it makes them more competitive from a trading perspective. So that's why he says, let's get the US dollar down. Well, all of this is built around the fact that you've got this real discrepancy in interest rates. And so it's pushing everybody in the direction of getting interest rates common across the world, but that also has put pressure, again, on currency wars. And that's not good either. And so these are just some of the factors that we worry about in terms of investing. And so negative interest rates, let me just summarize by the following. This is a sign of excessive debt in the global system. It is a sign that we have taken the debt growth almost to its limit, and we need to be very careful. So on this slide, the last one I have here before we just talk quickly about our performance and then hand it over to the guys to talk about our companies, what does that mean in your portfolios? We've talked about this for years now. It means that we want to buy hard assets and we want to keep some powder dry, absolutely. But in particular, what you probably have seen if you're looking at your portfolio over the last 3 months, 4 months, 5 months, is the weighting in the precious metal sector has slowly been going up as we take advantage of the volatility in that area. And so the actual weighting across our whole book of business right now is about 13.5% in our client accounts. And with 72% invested in equities and the rest of it in short-term bonds and cash investments, that means about 20% of your equity investments now are actually in precious metals. And so it gives us a really nice hedge. Will we take that up a little bit more? We might take that up so that it's 22, 23% of the equity exposure. And the reason we're doing this is because, first of all, values are cheap in this area. So we think it's offensive. We can make money on the offense. And secondly, it's defensive. If we do go through a problem in the global financial system, gold, silver, and stocks related to precious metals should do very well. And so those are stocks that go up. And so that's exactly how we're trying to fine tune the investments, as well as owning equities that are, hard assets, really, really well-run businesses. You're going to hear about two of those in just a second. So in the royalty space, which is where we have our exposure to precious metals through the royalty companies, which we've talked about before. We have Franco-Nevada. We've got the stock codes there on our sheets: Franco-Nevada, Royal Gold, Wheaton Precious Metals, Sandstorm, and we also have a little bit of Abitibi in a number of people's portfolios. And so that's one of the key fine-tuning or adjustments that we've been making in terms of our portfolio. Just quickly, in terms of our whole book of business, these are the sort of the numbers that we've been producing after all fees. We call this a balance, only because it's about 70% equities, 30% bonds, and short-term cash. And you can see the numbers here. And over the last 5 years, we've been compounding at about 7.8% a year. Which is a very good rate, particularly when you consider the ups and downs of the markets and so forth. And that's based upon 70% equity, 30% in cash or short-term investments. Then the last slide, in terms of performance, just zeroes in on our equity investments. And you can see here that if we just take our stocks and we compare that to the TSX, which is the Toronto market, and the S&P 500, and again, these are the total return indexes, so dividends all reinvested. If we go back, say our 5-year number, for example, we've been averaging in our stocks about 12% a year. And the S&P is at 10.1, and the TSX is only 2.8. And so again, you can see that we've actually outpaced those indexes significantly. And remember, our 100% equity weighting would be about 50% Canadian, 50% US. Over the last year, we've been very fortunate. If we go August over August, our stocks are up about 20%, and that's up against the TSX at 2.5 and the S&P at 2.9. So we've really walloped the market. So we don't expect that kind of outperformance to continue in that dramatic fashion, but we're going to work hard to try to keep it going. But it's been a great last year or so in terms of our investing. So that's just a quick update there. What I'm going to do now is I'm going to turn over the presentation to Jesse, who's going to zero in on American Tower, which is an important company that we have in our portfolio, and he'll fill you in on that. So Jesse, over to you, sir.
Thank you, Jonathan. As Jonathan mentioned, I'll quickly do a recap of American Tower. American Tower is an operator of multi-tenant telecommunications real estate, and that's just a fancy way to say cell towers. They lease out space on their structures to wireless carriers, government agencies, and radio and TV broadcast companies. In addition to leasing out their space, they do provide some ancillary services, and this includes backup power for the equipment and some monitoring services. Competitively speaking, American Tower is one of 3 major U.S. tower companies, and it has a large and significant international presence. Now, there's many benefits, but there's 2 main ones. And the first one is, of course, inherently geographic diversification. American Tower operates 171,000 sites across 17 countries in 5 continents. So we have exposure to different countries, different economies and markets, and everything that comes with that, different technologies and demographics and so forth. So we're not concentrated in one particular area. And then secondly, there's a technological diversification. There's different, as we know, we operate largely on our 4G network here in Canada, developed economies and countries, they are starting to roll out the next generation of transmission technology, and that's called 5G. But American Tower, with its broad international reach, it can have exposure to 3G even in some African countries and some underdeveloped countries, to 4G in some major developing economies such as India and Brazil, which are just starting to roll out 4G, and then 5G in the US, in Europe, and Canada. So it has great diversification in terms of technology. I'm quickly going to pull up the slides, and then you can see on the next slide here a diagram that really helps show the aspects of operating a tower business. We see that American Tower is actually not responsible for the actual equipment and transmitter. That kind of equipment is operated by the cell providers. This means that American Tower does not have to continually invest and change the equipment as technology advances, or pay to add more equipment onto the tower as data growth explodes. So American Tower is solely responsible for the structure and real estate. So that means there's tremendous operating leverage in the business. That means the additional cost of adding a new tenant to a tower is very little, while the revenue is large. There are just, and this is just one attractive quality of the business, that of operating leverage. It is a hard asset business, which is limited from technological disruption and the capital intensity that goes along with the capex involved in adding equipment, and equipment changes as technology changes. So that's some aspects involved in running a tower business. On this next slide, you see the data growth story and trends that I'm sure we're all familiar with. As data use grows and networks become more stretched, locating equipment on more towers and upgrading that equipment are the primary solutions for carriers. And this is great news for American Tower. We see that in the US over the forecasted time period, out to 2024, we're expecting a 33% compound rate of data usage. We have unlimited data plans in the US, and we're starting to roll out 5G technology. So the growth rates for this developed market are continuing to grow significantly. In countries such as India, we see 11% CAGR over the forecast period. These growth rates could eventually converge with the developed market growth rates as they begin to roll out their 4G networks. And as we know, the difference from 3G to 4G is a significant uptake in the data consumption as the technology permits. So the data growth story is strong, and we see very strong forecasts, which bodes well for American Tower. Looking at the business, we see fantastic fundamentals. We have the long-term secular revenue growth tailwinds from the data growth we just saw on the previous page. So this translates into great revenue growth for American Tower. They have contracts with inflation escalators, and that's approximately 3% in the US per year, with investment-grade counterparties. So this translates into an 8.6 organic tenant billings growth, or just organic growth, meaning growth that is involved just from the business itself and doesn't come from acquisitions or other transactions. So there's very strong revenue growth. And I pointed out the operating leverage earlier, but this chart really puts it into perspective. As you see, with one tenant, we have the upfront cost of the tower itself. And as we move on to two tenants, we are able to capture $30,000 more in revenue with only a marginal increase in operating expenses. And the same thing goes for 2 tenants to 3 tenants. So you can see what that does to the last line, return on investment. The leverage is quite large and jumps up very quickly. So it's a fantastic quality of a great business with double-digit return on invested capital numbers. In this last chart here, I show the difference, the price return over a 5-year period between American Tower and two well-known operators, AT&T and BCE or Bell. We see the difference in price return, and you can also see the total return. Dividends are important component of the return for AT&T and Bell. But this really underlines the value proposition that American Tower provides and how important it is to be in the right place on the value chain. A lot of people might understand the data growth story, but capturing the right component and being in the right company in the overall market, you can see the significance that has. I'll turn it now over to Andrew Chang, and he can explain Thermo Fisher here.
Thanks, Jesse. There are many subsectors within the healthcare and science industry that offers many different opportunities for investments. Every day, there's progress made towards new scientific discoveries and breakthroughs. One company that is helping to empower these scientific advancements and developments is Thermo Fisher Scientific. Thermo Fisher Scientific is the world's largest manufacturer of science and laboratory equipment. They have an extensive breadth and depth of equipment, tools, accessories, and capabilities that cover across a wide range of different areas within the science field. Now, one of the attractive qualities of Thermo Fisher is that it produces highly specialized and highly engineered products, which means its products cannot be easily commoditized. Now, Thermo Fisher covers across a wide spectrum of the science field, and this allows the company to be a major partner to pharmaceutical, biotechnology, government, and also academia. One of the things that we look at when we evaluate different types of companies is its business model. This allows us to be able to get through the fads, be able to uncover what really drives the business rather than just rhetoric in the news about a company. Thermo Fisher has very attractive business model. It has a razor blade model, which allows it to benefit from its extensive offering of laboratory equipment while offering clients and customers a stream of consumable products. Now, this stream of consumable products allows the company to generate a recurring revenue and allows the company to have a predictable and stable business model. On the next slide, I'm going to be going through just 4 of its business segments and going into a bit of a deeper dive of its different products and capabilities. So the first business segment that I'll cover is Life Sciences Solutions. And this business generates $6.3 billion in revenue. It has a wide offering of instruments, cell cultures, and reagents, which is a mixture of chemicals, and consumable products, which is used in medical and biological research, discovery of new drugs, vaccines, disease diagnosis, and genomic research, such as DNA sequencing. For instance, Thermo Fisher's genetic analyzer was the foundational platform used in sequencing the first human genome. Also, the 2017 Nobel Prize winner in chemistry used systems manufactured by Thermo Fisher in their groundbreaking work in cryo-electronic microscopy. The next business segment is Analytical Instruments, and this business generates $5.5 billion in revenue. They develop highly specialized instruments that are used to identify and quantify chemicals, proteins, and biological entities. These types of instruments include electron microscopes, spectroscopes, chromatography, and mass spectrometry systems, which is used for various applications from drug discovery to toxicology research. The next business is Specialty Diagnostics, and this generates $3.7 billion in revenue. They have a portfolio of diagnostic test kits, reagents, culture media, and instruments used in clinical healthcare, pharmaceutical, and food and safety. They have a wide range of applications from tumor markers testing, disease diagnostics, testing of allergies, detecting contamination, and testing for organ transplant matches. And the last business is its laboratory products and services business. And this generates $10 billion in revenue. It has a wide portfolio of laboratory products, chemicals used in virtually every type of laboratory application. This makes it a wide provider across various different science fields. It makes its products available also through its e-commerce platform. Its e-commerce platform has over 1.5 million laboratory products, and this includes capital equipment, instruments, consumables, and water purification systems. Thermo Fisher is also one of the leading contract development and manufacturing organizations, since it acquired a company called Patheon, which was a leading CDMO for the pharmaceutical and biotechnology sector in 2017. CDMO is an outsourcing organization that helps manufacture drugs for pharmaceuticals and biotech companies. CDMOs provide outsourcing to both small and large pharmaceuticals. Now, by combining Patheon's CDMO capabilities with Thermo Fisher's clinical trial services, Thermo Fisher is able to help its customers bring drug formulation from development to commercial production. It makes it an even stronger partner for the pharmaceutical and biotechnology industry. On the next slide, I will briefly discuss our investment rationale, why we like a company like Thermo Fisher. The first reason is that it has a predictable and stable business model. Thermo Fisher is a key partner to customers across the science and medical spectrum. What we like about it is that it empowers all areas of science and pharmaceuticals. We don't have to predict which particular area of science or medical will be the most successful or the next big thing, because it is diversified and touches across all fields of science and in the pharmacy industry. Also, when investing in this industry, some areas within the biotechnology industry can only last for a few years, where we like to look for companies that will compound over time and ultimately have a holding period of forever. We like this industry. We like this company also because it does provide products and services to growing areas. The science and pharmaceutical field will continue to increase with aging population as new diseases and diagnoses are being found. More demand for pharmaceutical drugs and applications will continue further. We also think that this business has a stable profitability. And this is because it has a high percentage of its revenue in recurring products, which comes from consumables and service. So this gives it an annuity stream. Now, the reason why we like Thermo Fisher is because it has significant manufacturing and distribution network. It has significant capabilities, and it also has an extensive portfolio of solutions, which outpaces many of its competitors. Its extensive portfolio is not reliant on one or a few products. For example, pharmaceutical companies that might be reliant on a couple of a large gangbuster drugs. Rather, it has a diverse breadth across all areas of science. Thermo Fisher also has a large manufacturing and distribution capability across many geographic locations. It primarily has manufacturing sites locally, which makes it far more easy to distribute its products to its local customers. Also, it has end-to-end capability in drug development, clinical trials, and manufacturing services. Its CDMO business has 2,400 scientists, and this business develops or manufactures over 25% of the top 100 drugs. The next reason why we like Thermo Fisher is because we believe it has multiple levers of growth. Its organic growth is driven by its extensive R&D capability. Thermo Fisher outpaces many of its competitors, has over 5,000 R&D scientists and engineers, has over 7,500 patents issued globally just within the past 5 years, and it spends over $1 billion in R&D, which makes it a leader in its class. This internal growth enables it to develop new products with strong profitability. Another area of organic growth is its emerging markets. Emerging markets are seeing an increasing rise in the middle class. As public health regulation becomes more established, there's an increasing demand for disease diagnostics and drug development, which gives emerging markets large market for many of Thermo Fisher's products. And high growth in emerging markets accounts for over 20% of its total revenue. So this is a large contributor to its growth. Another lever of growth is acquisitions. Thermo Fisher has a history of making very profitable strategic acquisitions that helps broaden its breadth of offering and capabilities. And it builds upon these acquisitions through its R&D innovation. And lastly, a company that does not produce good financial results is a company that we would not want to look into. And Thermo Fisher has fantastic financial results. From 2014 to 2018, it has a free cash flow CAGR, compound annual growth rate, of 17%, which is fantastic growth in free cash flow. It also has a low debt to equity ratio, which means it can take on debt and it won't hurt the company. This allows the company to have a good, strong balance sheet. And lastly, the company has been able to expand its operating margins over 400 basis points. Now, for such a large company, that's quite significant. This means that it's very efficient in integrating its acquisitions and making a company more lean and efficient. Now, the last slide here just shows just how important it is when it comes to investing, looking for specific areas of an industry with growth and the specific company. So here I have a comparison of Thermo Fisher and 3 of the largest pharmaceutical and biotechnology companies. From January 1 of 2010 to January 16 of 2019, Thermo Fisher has generated a price return of over 500%. Now you compare that to Merck, Pfizer, and Roche, all very good returns, but you see that large divergence. And you see that large divergence is attributed to just the offering that Thermo Fisher can provide its customers, just its breadth to various different customers. And it's also less susceptible to some of the government pressures that have been encumbered on these pharmaceutical companies, with greater pressures on the pricing decreases and greater emphasis on healthcare for all, as we hear in the news with many of these politicians. Thermo Fisher is well positioned to continue to grow at a faster pace than some of these traditional pharmaceutical and biotech companies that we see in the healthcare market. I'm now going to switch over to Jonathan for Q&A.
Yeah, that's good. Don't go too far there, Andrew. But no, that's helpful. So again, there are a couple of companies, American Tower and Thermo Fisher, which are just have amazing business models. I mean, they're really powerful. When you look at something like Thermo Fisher and you compare that to the big drug companies, you can see that if you can be in that razor blade type of business where you have reoccurring revenue, you can compound that revenue, it's long term, you become a major partner player within that industry, you can really grow much more quickly than even if you have a drug that goes well for 10 years, 15 years, and then it's off patent and you have all that competition. And as Andrew explained too, the political pressure on the pharmaceutical companies is intense. Not that there isn't political pressure on Thermo Fisher and analytical equipment, but not as much, and much more diversified, much more predictable business. One quick question that came through, that CDMO, that contract development manufacturing organization, all these little buzzwords. Why do the pharmaceutical companies want to outsource more and more of that manufacturing, and how is Thermo Fisher then really profited from that? Sort of what are the pressures there that allow them to do what used to be largely done by the pharmaceutical companies themselves?
Right. Yeah. So the CDMOs cater to both the small and large pharmaceutical companies. So the smaller pharmaceutical companies would go to someone like Thermo Fisher for its CDMO capabilities, primarily because they don't have the capabilities. They don't have the manufacturing depth or capacity to be able to manufacture its drugs. Oftentimes, these smaller biotech companies are often in the discovery phase. And so their concentrated efforts is in that, and they don't have the funding to be able to produce the drugs. So they go to something like a Thermo Fisher. You also, on the other spectrum, you also have the larger manufacturers. Now they have large capabilities, but during certain timelines, they might outsource it to a Thermo Fisher, which will be able to help pick up the upload and help them move along the timeline process to make it commercialized for its drugs.
Oh, so for the big guys who actually have manufactured, they can streamline, or they can, if there are demands, and they can fulfill, this extra demands, then they can fulfill that. And I think a lot of times, in some cases, that capacity can sit idle, so they're not as efficient with the capacity. Right. Whereas Thermo Fisher, by having multiple players, then can really organize and be efficient with its manufacturing capacity. Interesting how that shifts there. Right. It's amazing how the market's constantly looking for the most efficient way to produce and to manufacture things. Right. Interesting. So I'm going to just ask a quick question of Jesse here. And in terms of the American Tower, you saw that chart also in terms of American Tower. I mean, it blew me away. I mean, we've owned it for quite a few years now. But when you compare it to BCE, which is supposed to be the standard in Canada, it pays your dividend and it just chugs along nicely. But when you look at how American Tower, which is an infrastructure company, has just walloped, just beaten significantly these telcos, it's phenomenal. But the one issue that comes up that people often ask about is this: we're seeing it here in North America, the shift from 4G to 5G, which is going to be quite an amazing shift. Is there business opportunity, or is there business threats there in terms of risk for American Tower, and how are they going to seize on this? What does that kind of mean from their perspective? Do we need more towers? I mean, what happens in terms of that big shift that's taking place?
5G basically, as you said, is the new generation of transmission technology. So it's a shorter millimeter wave, which means it can't transmit data as far as 4G or 3G. So what that means is that there's going to have to be more sites for data to be transmitted. Now, this rollout is going to occur firstly in really urban markets. Some say that American Tower is located in rural markets. I believe there are monopolies there with the towers, because it's essentially a mini monopoly every time you have a tower. Those will be preserved just by the physics of how that works. The great news with 5G is that there's just going to be a consumption of data. We talk about Internet of Things, we talk about automation. All this is going to require mass amounts of data. It's going to encourage the data for new products, for new applications, and that in general is good for American Tower.
So more data, more sites, just more intensity overall. The one thing that we found kind of fascinating is our largest position across our group is actually Brookfield Infrastructure Partners, and our clients see that in your portfolios. And then we also own American Tower in many of your portfolios, quite a few of the portfolios. And those are two significant positions. And one's 100% towers, American Tower. But Brookfield, more recently, Jesse, they also have made massive acquisitions in wireless towers. So when you own Brookfield Infrastructure, you also are getting a large number of wireless towers. They see that as just high growth infrastructure. And remember, they can go anywhere in infrastructure, but they're really zeroed in on this area. But maybe just comment just quickly on the fact that these two now are just massive players in India, which is kind of interesting that we have two companies and they seem to be the biggest players in India now.
Yeah, you're right. Brookfield kind of has a mandate. It's infrastructure, but they're so big that they can go anywhere. So that the fact that they go to India and in towers really demonstrates the underlying economics of the business, and they see it as such a great business. You're right. So Brookfield has recently announced about 2 months ago that it will acquire the largest telecom infrastructure company in India. So it's the #1 player now, and American Tower is the 3rd largest player. So this really speaks to what the management, because part of our job is to look at management and invest in great business leaders and their skills and abilities. They see India as a fantastic long-term market for them. You have a young population, you have a transition from 3G to 4G, a growing middle class, and in general, just the huge uptick in the usage of data. So both these companies have made their way into India, and they also are such great operators themselves. So they entered this market and they continue to build organically within that market after they enter, because they have the skill and expertise to do so. So we're very excited at this market, and we'll be looking with much interest to see how this develops.
Okay, no, that's excellent. Well, we've gone certainly full time here. We want to give you as much information as possible. We're very passionate about what we're doing, and we're also very excited about our new website too. So I just wanted to mention that quickly. We've just launched a new website, so www.rocklink.com. Encourage you to go there. And our next webcast is planned for December the 12th, and so a few months out. But hopefully that gives you a good update on what we're doing in our firm. Careful. These are very unusual days. The global monetary situation is not healthy. It's under a lot of stress, which means we really do have to own tremendous companies, great businesses, have some good hedges built in there, as we talked about, and also a little bit of powder that we keep dry so we can take advantage of volatility in the market. So we appreciate all of our investors, and thank you very much for your loyalty. And it's been a good couple of years here, the last couple of years, and we're looking forward to trying to keep up with the returns and keep investing in great businesses and great companies. If you have any questions, please call, email, contact us, and feel free to forward this webcast on. We'll have the rebroadcast of it on to any of your friends and people that might be interested in what we are doing in terms of investing. Thank you very much. Bye now.